Hey everyone, this is Abhishek from Ingenetus Consultants and Provitt Private Limited. I got a very interesting comment from Mr. Mohit Sharma, who has asked me to make this video blog more rocking. I don't know how to do that. I will try to do my level best, but this is all financial analysis. This is all financial products. I don't know how can I make it more rocking, but I'll certainly keep that feedback in mind and try to make it more rocking. Probably sing a song in between or so. Anyways, thank you, Mohit. Thank you for the comments, and thank you everybody else also for liking our video blogs and liking and commenting on our video blogs. We request you again to ask as many people as you can to subscribe to our channel and to our video blogs. We are trying to spread the awareness of financial products. We're trying to spread what we think and what our perspective is about the markets and what about the products available. So do subscribe to them. And so today we are going to we discussed in the last blog about the differences in the taxation on debt and equity. Today we are going to do a differentiation between hybrid products and FDs. We are also going to explain you about SIPs and STPs. What are those products and how are they different? So let's go then. Let me just turn the camera towards my laptop screen and tell you about those products. I'll first of all do the differences between FTs and hybrid products. So this is the file for that. So let's say in FT, which is giving me at in fact 7.25% in these days, but let's say if I take it on a higher side at 8% as well. A post-tax return for a 33.33% taxation bracket person will be 5.34, a 20% taxation bracket would be 6.23, and a 10% taxation bracket would be 7.10%. These are the post-tax returns in an FT. Let me compare to a hybrid product in which there are about 80% bonds and 20% equity. Now, in a best case scenario, so I've taken two scenarios, a best case and a worst case. So let's say in a best case, bonds give me about 11% and let's say it gives me equity gives me 20% per annum for the next 3 years. So we are sitting at a Sensex level of almost 29,000 today. 20% per annum kind of an increase from here makes it almost 60% absolute, which makes it to, let's say we say that the Sensex will go to 48,000 levels, right? We're taking a very good scenario over here. So in 3 years, 80% of my investment, so let's say if I've invested 100 rupees, 80 rupees we've invested into bonds, that becomes about 109.5 at 11% per annum, and 20 rupees which goes into equity becomes 34.50 at 20% per annum. My total returns or my per annum returns goes to 14.70% per annum. And this is post-tax. So if you compare all the three scenarios of an FT, this is double the returns in an FT. Now some people might argue over the fact that these are the best returns, so I've taken a worst possible return. So let's say bonds gives me about 10, 10.5, 11%. I've taken about 10% in bonds, and I've taken a minus 15% per annum in equity. So let's say that Sensex is at 29,000 right now. It tanks to about 45% on an absolute basis. So let's say the Sensex reaches back to about 17,000 levels, right? In that case also, in 3 years, my 80 rupees becomes 106.5 and 20 rupees becomes 12.5 rupees. That's a return of 6.40% per annum post-tax. If I see my 33% taxation bracket of an FD over here, that's a 5.34 return, and compare it to 6.40, it's still higher. 20%, 6.23 is still higher than 6.40 is still higher than 6.23, and it is slightly less than 7.10% for a 10% bracket person. Now, why I'm doing this analysis is that even the worst case scenario of a hybrid fund is almost equivalent to the best case scenario of an FD. And of course, the best case scenario of a hybrid fund is absolutely double of an FD. But why one should go for an FD then? If I'm taking the Sensex levels falling from 29,000 levels to even 17,000 levels, and still I'm getting a return which is almost equivalent to an FD, why go for an FD? Why not just go for hybrid funds or even debt funds for that matter? The differences between debt funds and the FDs I already explained you in the last segment. Now let me try and explain you the differences between SIP and STP. What is an SIP and STP? SIP is a systematic investment plan, and a systematic transfer plan is what we call as an STP. So let's say if I get a salary every month, I decide that I want an X amount out of that salary to be invested every month. I call that an SIP. And an STP is, let's say if I have a lump sum amount. So let me take it in figures. Let's say I earn 1 lakh rupees every month. Out of that, I need that I invest about 30 to 40,000 rupees every month in a mutual fund. That is called an SIP into mutual fund. Let's say instead of every month, I have a lump sum with me lying in a bank account, which is, let's say, for example, 20 lakh rupees. Now, what do we do with this 20 lakhs is, for an aggressive client, we don't invest this 20 lakhs directly to equity. We feel that we or anybody else cannot predict or time the market to 100% accuracy. At max, if somebody can go and time the market and predict the